Welcome to the session on mortgage-backed securities. We're going to introduce you to a variety of the more commonly encountered types of mortgage-backed securities, pass-through securities and CMOs, that is for collateralized mortgage obligations, as well as a lot of the concepts used to assess the attractiveness of mortgage-backed securities and a lot of the details to help understand mortgage-backed securities and how they work. So to give you a brief overview of what to expect over the course of the session, we'll start by introducing, in general, mortgage-backed securities and the debt instruments underlying those securities, which are individual mortgage contracts. Then we'll talk about in detail the original type of mortgage-backed security, which is known as a pass-through security. That'll be a good point at which to introduce some of the unique aspects of mortgages and what causes them to have risks that differ a bit from many other types of securities. That's the uncertainty related to the prepayment, what they call prepayment risk, but also talk about as the embedded optionality or uncertain average life. Then we'll also want to introduce some of the numbers that are used to convey information about rate of return, price, prepayment rates, and so forth. And then towards the end of the session, we'll focus on a different type of mortgage-backed security that is quite a bit more complicated than pass-through securities, and those are the CMOs, or collateralized mortgage obligations I referenced earlier. So to start with a very basic introduction, let's think about exactly what is a mortgage-backed security. And a mortgage-backed security at its simplest level is simply an investment where the cash flows to investors are ultimately coming from mortgage loans. Usually not one. Usually there's a group of mortgage loans held together in some legal entity, oftentimes referred to as a mortgage pool. And these structures can get quite complicated. So sometimes between the payment by the borrower and the cash flow ultimately distributed to the investor, it might wash through more than simply an individual mortgage pool. So we'll touch on some of those more complex structures. But ultimately at base, that's what distinguishes a mortgage-backed security from other sorts of investments. The cash flows to investors are ultimately cash flows being paid by borrowers on their mortgage loans, and that money ultimately, after passing through some number of hands, ends up in the hands of investors. So that's the intervening structures or securitizations reference there. Now, while most of the cash flows payable to investors are those cash flows being paid by the borrowers, but an important element to recognize in many mortgage-backed securities is there might be additional guarantees or credit enhancements. And so we'll have to take those into account where appropriate when trying to estimate the likely future cash flows to investors, whether they're coming from the borrowers or whether defaults or delinquencies by the borrowers are made good from some other source of cash, be it a government or government agency guarantee, some sort of private insurance, or for that matter, cash reserves inside of the structure itself. And as was obvious if you had a chance to think about some of the words spoken up to this point, is that there are risk factors that, well, that's true of any investment, of course, but in addition to facing the same sorts of risks investors and other fixed income securities face, like possibly default risk or the impact of inflation and how that affects the purchasing power of the monies actually paid out to you, mortgage-backed securities have very unique risks. And if we focus for the moment on introducing those unique risks, there are two broad categories. One relates to the uncertainty about how rapidly or how slowly the borrower, known as mortgagor, is going to pay off the loan. And the biggest risk for the high credit quality mortgage-backed securities is, in fact, that uncertainty about the average life. So we'll want to look at what are the factors that cause that sort of uncertainty and how we might get some sense of whether the rate of prepayment is likely to be high or low and how that will impact the value of our mortgage-backed investment. But then in addition to that, we have to also take into account credit risk. Now, there are certain types of mortgage-backed securities, those backed by a government or government agency guarantee, where credit risk is not that much of a concern. On the other hand, there are many mortgage-backed securities that are not protected by that sort of guarantee, in which case then we have to take into account the particulars of the credit risk. And the credit risk issues then will relate to two broad issues. One is, what is the quality of the loans? And that will have to do with what are referred to as the underwriting standards, how serious the original borrower, I should say the original lender, was in assessing the credit quality of the borrower, and what are those aspects of the loan and the things that affect those sorts of credit risk considerations, like was there a large or small down payment, what sort of income or assets the borrower had to fall back on. In fact, why was the property purchased? Was it purchased for use as a residence, or was it purchased as an investment? And as we'll see later, all of those things go into assessing the credit worthiness or amount of credit risk we think we're exposed to. But then, in addition to that, we also have to take into account what's the impact of any guarantees or credit enhancements in terms of possibly offsetting credit risk issues we feel are tied to the quality of the loans themselves. And here we have a simple diagram, and it's very, very simple, but it tries to capture the idea. Where is the money that's ultimately going to be paid out to the investors coming from? Well, it's ultimately coming from a pool of mortgages, a group of mortgaged loans that have been put together, as they say, securitized for this very reason. And of course, those loans are the contracts that the originating lender entered into with the borrower, the buyer of the property, the party that owes the payments under the mortgage, the mortgagor. And so as those mortgagors, the borrowers, make payments on the loan, those monies are passed on through some number of hands. The level of detail we haven't captured here, but will be captured in subsequent exhibits. But then they pass through one or more structures, and ultimately it's primarily the money paid on the part of the borrowers, the principal and interest they have to pay back to pay off the liability. It's those interest and principal payments that ultimately are paid on out to the investors. Although how the investors are sharing in those distributions, well, that depends on the specific type of mortgage-backed security and the terms under which it was issued, and those are some factors we'll talk about further on in the discussion. Now, if we consider the creation, sometimes they'll call the origination of mortgage-backed securities, it's what's referred to as asset securitization. Now, mortgage-backed securities are part of a category of a more inclusive group of what is sometimes called structured securities, because there's a number of different types of structuring or work that goes into creating the security and the underlying and associated legal structures. But the pooling of the mortgage loans for purpose of serving as the ultimate source of cash flow payable to investors, that's what's typically referred to as asset securitization. And that's the most basic sort of structuring that goes on. And that's just pooling together a bunch of mortgage loans, usually very homogeneous loans, although in some instances there might be a variety of different loan types that are pooled together. But in the vast majority of instances, you're looking for loans that are as similar to one another as possible for reasons that will come out as part of the ensuing discussion. And so that asset securitization is the formation of the mortgage pool that will be the ultimate source of cash flows to investors. Now, you might say, well, what's the difference between holding an individual mortgage loan and investing in this pool? Well, there's two broad reasons that would generally cause the securitized loans to be more attractive than the individual loans. One is the benefit of diversification, because by investing in the pool, in effect, you have exposure to all of the loans in the pool. Thus, your investment is diversified across many borrowers, as opposed to only one borrower if you were to own a mortgage itself. And the other potential advantage is that, in general, securitized assets are going to be a lot more liquid. Part of the securitization process is structuring these instruments in a form that makes the ownership interest relatively easily transferred to some other party, as opposed to individual mortgage loans. Mortgage loans can be traded between parties, but each loan is in effect a unique document and will require going over in details the particulars of that particular loan. Because of the standardization of these structures and therefore the common features and the common legal framework, it makes the passage of ownership from one holder to a subsequent holder relatively much more simple. And the presumed benefits of these mortgage-backed securities markets don't just accrue to the investors who now have an investment that is diversified and more liquid, but the reason these markets were created and their development was fostered by many governments is that it makes the mortgage market work a lot more efficiently. It's a way of recycling capital back into the mortgage lending system, thus presumably allowing borrowers to obtain funds to buy property more easily with all the presumed benefit that accords to society, because generally property holders are perceived to be more prudent and responsible citizens. Now, that is one part of the structuring of structured securities. The other part of the structuring is potentially in the payout to investors. Now, the securities we're going to look at first, the pass-through securities, there's no structuring on the back end of the payouts. In pass-through securities, as we'll see, everyone is getting a proportional share of the cash flows. But as we'll see, that gives investors a relatively more difficult time in managing the risk exposure of holding the investment. So some number of years after the first pass-through securities were created, they started structuring the payouts in the back end. And those issues we'll talk about when we get to collateralized mortgage obligation towards the end of the session.